Hello, it's Simon Zutshi here, and in this YouTube video, I'd like to answer the frequently asked question, are interest-only mortgages risky? Now, this is a question I'm often asked by new property investors who are not sure if they should take out a repayment mortgage or an interest-only mortgage for their investment properties. So let me give you a little background, and I'm going to answer this question for you. And the answer is, well, it kind of depends. It depends on what your strategy is and what you want to achieve. So let me explain in this YouTube video. By the way, if you like the video, please press the like, make sure you subscribe and hit the bell icon to make sure you get notified whenever we bring out a new video. So first of all, let's talk about repayment mortgages. Now, most homeowners who are getting a mortgage on their own home where they're living, they will get a repayment mortgage. And they'll typically take out a 20 to 25 year long mortgage. And the idea is by the time they retire, so when they stop work and usually their income comes down, they want to have paid off their mortgage in full. And that's what the vast majority of people do. Now, a repayment mortgage, the idea is each month you're paying a little bit of capital and the interest. So let's say you borrow £150,000 in 20 years' time, you will have paid off that £150,000 and hopefully your property has also gone up a lot in value. So that's a repayment mortgage. Now, as investors, we often take out interest-only mortgages, and that's for several reasons. First of all, if you're making a repayment mortgage, because you're paying an element of capital each month as well as interest, the payment's higher than a mortgage that's just an interest-only mortgage. And if you want to get cash flow from your property, it's better to have an interest-only mortgage. Now, the concern, the risk there that people are worried about, they say, well, what about in 20 years' time when I need to pay back that £150,000 I borrowed? Because remember, with an interest-only mortgage, we're only paying the interest. If you borrow £150,000 now, in 20 years' time, at the end of the mortgage, you still owe that £150,000. And people are worried about, well, how do I pay that back? Well, what you need to remember is two things. First of all, in 20 years' time, the value of that property is probably going to be much higher than it was when you bought it originally 20 years ago. Now, there's no guarantee that's going to happen, but if you're investing here in the UK, we have this growing population and we have a limited supply of accommodation, which means over the long term, property prices go up. Now, the UK government say we need about 300 new homes every year. We're only building 200,000. This is why generally prices go up. Now, obviously, as we know, property prices don't always go up. We saw a property market crash in 2008, and some people believe we're going to see a property market crash in 2023. Now, we're certainly seeing a correction in prices. Prices are coming down, but I don't think we're going to see a crash because of this strong underlying demand that's just not enough accommodation in the UK. So if you buy a property now, in 20 years' time, there's a very good chance it might have doubled or even doubled in value again. So if you buy a £200,000 property and you get a £150,000 mortgage, interest only and £50,000 deposit, don't worry about the deposit now. I'll tell you where you get that later on. But you buy a £200,000 property, in 20 years' time, that property could be worth 400, it might even be worth 800,000 if it's doubled and doubled again over that 20-year period. You can go onto Land Registry, just Google it and look at the house prices, and you'll see over the last 60 years, the average has been that prices have doubled pretty much every 10 years. Now, it's an average. It doesn't happen every 10 years and it doesn't happen everywhere. But I've been investing for almost 3 decades. And I can certainly say, look at my portfolio, I've seen properties double and double again pretty much every 10 years. So that's probably going to happen in the UK. So bearing that in mind, that the property could be worth a lot more in the future. If you've got that property with, say, £150,000 mortgage on an original £200,000 purchase, in 20 years' time, it's probably going to be worth at least £400,000. And remember, the mortgage was only £150,000. So one exit strategy you could do is maybe sell that property to pay off the mortgage and then bank that profit you've had. Now, when you sell a property that's not your own home, you have to pay tax. It's called capital gains tax, but still the tax won't be as much as the profit you've made because you've kept the original mortgage at the same amount. Now, let me put this into perspective to explain how you can build a portfolio, because you might say, well, that's great, but I don't really want to be selling my properties. I'm buying them to keep long term. And so instead of selling and paying off the mortgage, you could just remortgage. And this is another important distinction, the difference between a homeowner mortgage and an investment mortgage. Remember, on your own home, when you get to a certain age, the lenders say, well, you're going to be retired, and how are you going to be able to afford a mortgage? That's why the plan is for most people to pay off their property before the end of the mortgage term. That's why they have a repayment mortgage. With an investment property, remember, it's not really based on your income. It's based on the income that comes in from the rental income. So it doesn't really matter how old you are. I've got a client who's 69 and he's just arranged some 20-year mortgages on his properties. And he was joking to me, I hope I live as long as these mortgages are on these properties. But the lenders are happy with that because they know the tenants are covering the cost. There's more than enough profit. And in the next 20 years, those properties are probably going to double and double again. So interestingly, when we buy our own home, we might get a repayment mortgage, but when we get investment properties, we might get an interest-only mortgage. Now, some people get interest-only mortgages on their own home, and that's where there might be a bit of a risk, because at the end of that term, you need to be able to pay that money back. Now, if you don't have any other properties, that could be risky. But as a property investor, we have a number of other properties which, as they go up in value, we could remortgage some of our investment properties, take the money to clear our interest-only mortgage that we have on our own home. Now, why might we have interest-only on our own home? Well, many property investors or people who want to invest in property, they realize that the equity in their own home could be used to grow their investment portfolio. So most people who've had a repayment mortgage, they've been trying to pay it off for years and years, well, they learn about property investing and think, hang on, why don't I use the equity in my own home? Now, they increase the borrowing, which means there's an increased payment. So by changing from a repayment to an interest-only mortgage, it keeps the payment down. Now, bear in mind, if you have an interest-only mortgage on your own home, you will need to pay that off at some point when it reaches the end of the mortgage term, and it will be difficult to remortgage on your own home when you're a certain age. It's different from investment properties. So what a lot of people do is they might recognize there's equity in their own home, they remortgage, make that interest only, knowing that they're going to buy some investment properties. As they go up over time, they'll remortgage those to clear their own mortgage in full. Now, let's put this into a little scenario. So let's say you go out and you want to buy, I don't know, 6 investment properties, and you buy those properties at, let's say, an average of £200,000 each. You would put in a £50,000 deposit for each and £150,000 buy-to-let interest-only mortgage. So you rent those out, and the rental income not only covers the buy-to-let mortgage, but gives you enough to cover the mortgage on your own home, the increased borrowing, and also gives you some extra cash flow, which is why people invest in property in the first place. So those 6 properties, you buy them for 200,000 each. 6 means you've got 1.2 million pounds of property. Then in 20 years' time, those properties probably double and maybe even double again. But let's be conservative. Let's say in 20 years, they only go from 1.2 million, doubling up to 2.4 million. Now, remember, on those 6 properties, you had a mortgage of £150,000 each. So 6 times £150,000 is a £900,000 debt on your buy-to-let properties. And the value was 1.2, which is, you know, the mortgage is 75% and the equity is 25%. But now they've doubled in value to 2.4 million. You've got more like 1.5 million pounds of equity and £900,000 of debt. What you could do, so the properties have gone from 200,000 to 400,000 each. What you could do is maybe sell 3 of the properties. So if you sold half of your portfolio, so you've got 6 properties originally, you sell 3 of them, they're each worth £400,000 each. 3 times 400,000 would be 1.2 million. You've got to pay some capital gains tax when you sell, but there should be enough, 900,000, to clear mortgages on all 6 properties. So as the properties have doubled in value, you've sold half of them to clear all the mortgages. The remaining 3 properties worth £400,000 each would have no mortgages at all, and you'd have all that rental income coming in, which would be a great pension for your future. So that's a strategy a lot of people do. They build a portfolio, they plan to sell half of it to clear all the mortgages by the time they retire. But remember, as an investor, we don't necessarily need to pay off all these mortgages. We could just remortgage. We could take out some money to clear our own home, which we do need to pay by retirement age, but allow the debt to keep on going on the investment properties, because remember, the tenants are paying the mortgages for us. Now, I don't want this to be financial advice. I never give financial advice. I'm just trying to educate you and open your mind as to some of the possibilities. So in my view, the answer to the question is, are interest-only mortgages risky? I believe on an investment property, as long as you know what you're doing, you buy a good property, they're not at all risky. And on your own residential property, they can be risky if you don't have a strategy to repay that loan when it needs to be repaid. But if you do have a strategy, it could be your property portfolio. Personally, again, as long as you know what you're doing, I don't think it's risky. The other thing you need to think about when it comes to risk and comes to mortgages is obviously interest rates. We've seen in 2022, interest rates shot up. And right now, there are many landlords who are on variable rates, which means they vary according to the Bank of England base rate. They now have very expensive mortgages, and on single let properties, some of those properties may not be making money. So those landlords have a problem. Now remember, interest rates are not a problem for everyone, because many landlords have fixed their interest rates, and some landlords have paid off their properties and have no mortgages at all, so they're not affected by interest rate rises. Now, if you're a regular viewer of my YouTube channel, or you listen to my Property Magic podcast, which comes out every Tuesday, you'll know back in about April, May 2022, I was saying to all my listeners, I said, look, guys, if you've got variable mortgages, you might want to think about getting some advice and maybe remortgaging those to fix the interest rates, because it looks like interest rates are going up. That's what we were saying at that time. And people who listened to that information at the time and took action, I've had lots of emails saying, thank you so much for educating us and making us aware of this. We fixed our rates and now we're very happy we've done that. So I would recommend that many of our videos I bring out, they are timely. If you haven't subscribed, subscribe to the channel, hit the bell icon. That means you're going to get notified whenever a new video comes out. So when we release these timely, important videos, you're getting the information at the correct time rather than watching them 12 months after they've come out, which may not be so relevant. So I highly encourage you to subscribe to the channel, click the bell icon to make sure you get notified. And if you like the video, hey, please like it. That helps us. More people see the videos. And if you've got any comments or questions, please post those below as well. So that's it for this video. I hope it's been useful. Do enjoy this YouTube channel. Got lots of training here for you completely free of charge. And as ever, I encourage you to invest with knowledge, invest with skill. Thanks for watching. I do hope you got massive value from watching this YouTube video. I'd encourage you to click on the link below to come and do the online training with me. And I've got another video lined up for you, which I think is also going to be really useful, that you should watch once you've registered for the online training with me. So invest with knowledge, invest with skill. I'll see you very soon.